Do you know who loves stimulus checks more than anybody else? Wall Street. What's up everybody, I am Jaspreet Singh and welcome to the Minority Mindset. Wall Street loves it when the government hands out stimulus checks, not because they get a $1,200 stimulus check, they make too much money to qualify for that, but because they know where people are gonna spend their stimulus checks. The government says stimulus checks are there to stimulate people who get the stimulus checks. I'm so stimulated! But that's not true. Your stimulus check doesn't come with any education on how to actually use your money to stimulate yourself. When people get stimulus checks, they don't suddenly become wealthier. They get this free money and then they spend it, and then the businesses where they spend their money become richer. Oh, and a lot of those businesses trade on Wall Street, which is why Wall Street gets very happy when the majority of people get a stimulus check. That's why people on Wall Street and investors love stimulus checks, because they understand the game. The government prints all this free money and they say that they want to stimulate the people. Then the people get this money and they're never taught how to use money the right way. So then they go and spend this money at businesses, many of which trade on Wall Street, and now investors and traders and Wall Street wins. About 40 million Americans lost their jobs between March and the end of May 2020. If you took a random sample of 100 working Americans in February 2020 and you look at those 100 people now, 25 out of those 100 people today would either not have a job permanently or they're furloughed. At the same time, the United States economy went from growing steadily in 2012, 13, 14, 15, all the way up to 2019, and now in 2020, it's shrinking. We have lots of people without jobs in a shrinking economy, which means we could be entering one of the most competitive job markets in history. But Wall Street and the stock market see light in this story. When the stock market hears that people are losing their jobs, it goes up. When the stock market hears that new stimulus checks might be printed, it rallies. And when the stock market hears that tens of millions of Americans are filing for unemployment, the stock market goes up again. Now, I get it. There's a lot more to the stock market than just people printing stimulus checks. I mean, you had the Fed manipulating the stock market by pumping trillions of dollars into the market. But what I want you to understand is how to find the opportunity in every crisis, especially as an investor, because this is a time where financial education is more important than ever, because you don't want to come out of this crisis on the losing side financially. The stock market on a very high level is where people go to invest their money based on what they think is going to happen in the economy in the future. Right now, 40 million Americans have lost their jobs in one way or another and have filed for unemployment. But this isn't the Great Depression. We have an unemployment program and stimulus checks being sent out, which is why almost half of people who have lost their jobs are now making more money in unemployment than they did when they were working a job. Now, I'm not going to go over the economic effects of that in this video, so if you haven't subscribed yet, make sure you do that. But Wall Street is loving this, because when people get money, what do? They spend it at Lululemon, Amazon, Kroger, Apple, or Netflix. And all of these companies trade on Wall Street, on the stock market, and all these companies have come to near their record highs. Back in 2019, you might remember that Wall Street was very worried because people were hitting a ceiling as to how much money they could spend. Wages weren't growing fast enough. People didn't have any more money to spend because they had already given their savings accounts over to their favorite businesses, and people couldn't borrow any more money because we had already hit a record amount of credit card debt and consumer debt in 2019. The majority of people were maxed out on how much money they could spend. But the government wanted the economy to grow faster, so we were in kind of this like confusing phase, because if we wanted the economy to go faster, we needed people to spend more money, but people had no more money to spend. There was no more way for them to do that. That's why in 2019, the Federal Reserve Bank started slashing interest rates as a way to stimulate the economy when we were in one of the strongest economies of all time, because they wanted to grow the economy even faster and make it cheaper and easier for people to borrow debt, even if they were already up to their eyeballs in debt. So we were walking this thin wire with consumer spending maxed out, with people having no savings, little investments, and then came this pandemic which blew people over the wire. Okay, alright, I got this. Ow! The whole economy was put on a standstill except for two things that kept working. One was that thumbs up button below, which if you haven't hit that, you might want to do that, and the Federal Reserve Bank's printing machine. The Federal Reserve Bank, or the Fed, is known as the central banking system of the United States, and they help kind of control and monitor the monetary system of the United States. So when the economy was put on standstill, the Federal Reserve Bank went to their money printer and they started printing trillions of dollars to inject this money into the economy and the stock market by providing liquidity to banks and other institutions who were running out of cash. This stopped the stock market free fall. Then the Fed started printing trillions of dollars to fund bailouts and stimulus checks. This made the stock market rally. Again, we're fortunate that this isn't like the Great Depression where there was no way for people to really stimulate or help the economy. The Fed has said that they still have more ammunition and they will do whatever it takes to prop up the markets and the economy and people. Well, bailouts mean that businesses have easy access to cash, which tells the stock market that the whole economy isn't going to go bankrupt. And stimulus checks means people have money to spend at businesses which trade on Wall Street. However, I do want to point out here that when these stimulus checks were sent out and these unemployment checks were sent out, a good chunk of America did use this as an opportunity to boost up their savings accounts. So good job on that. While saving your money isn't gonna make you wealthy, especially in a very, very low interest rate environment like we're seeing right now, saving your money is still better than giving all of your money over to Lululemon. Now, I talk a lot about financial education, but the reason this is difficult is because a lot of people, economists and the media and everybody, looks at the world as binary. Either people can be spending strongly, which means people don't have any savings. They've spent every dollar that they had and they're up to their eyeballs in debt, which means spending is strong. Or people are being greedy by saving their money and investing their money. You have kind of like two kinds of people. You have one kind of people who, as soon as they get their money, they want to spend it all. I call this the majority people. And then on the other hand, you have the people that understand the system and they want to learn how to use it to their advantage. This is why the stock market is loving what's going on, because they have factored in the idea that if the majority of people get free money, then the majority of people are going to spend all of it at businesses that trade on Wall Street. The unfortunate reality is that we are living in a debt culture where when the majority of Americans get $1, they feel like they need to go and spend this dollar or $1.20 through the help of credit cards and lines of credit and debt. Yo, check out my new car. My dealer gave me a sweet 30-year financing deal. And this is what we encourage, right? Consumer spending. This is what every economist and analyst looks at when they're trying to determine the strength of the economy. But it doesn't have to be like that. You can save and invest and spend all in harmony. Then when you understand how to do that, now you can go out and buy as many Lululemon leggings as you want, as long as you can afford it. The issue is, in order for the economy to grow more, people need to spend more money. And most traditional financial textbooks translate that to meaning that people need to go and take their savings accounts and hand it over to a business. But as a personal finance lover, an investor, and an entrepreneur, that's just plain wrong. It is not your duty to be broke to support the economy, okay? Let's just make sure this is clear. You are not an American hero for being broke. Yup, I just did my American duty by spending all my money at Gucci. First off, they're Italian, and second, no. It is your duty to be financially smart. That way you can take care of yourself, your family, and your community. And if more people did that, you are going to see the economy not shrink, but grow. This is where everybody thinks, oh, if people suddenly just became financially smart, then they would stop spending, and that would cause the economy to crash. That's a big lie. It's an emotional response, not a thought-out practical one. If more people became self-reliant and knew how to build their own wealth, you would see a natural free market redistribution of wealth, not through stimulus checks, but through people understanding how to use their money. Now, wealth inequality would no longer be a major problem in the world, and people would own ownership in the companies that make America what it is, and now regular people would have more wealth and resources to spend. Right now, what we're seeing happen is when the majority of people get stimulus checks, many people are just taking these checks and giving 100% of them to businesses, which make businesses rich, but it leaves people broke. But if more people knew how to use their money and become wealthy, and they took the steps to do that, now more money will naturally flow to regular people, and people would have more buying power to buy more of the things they want and actually be able to afford it. Sure, if this model did happen, then some businesses would get hurt. I mean, the banking sector and financing sector would get hurt because people wouldn't rely on a credit card or their bank or a financing company to buy a pair of jeans. But more people would have more wealth, which would let them buy more things, which would help the economy grow. You might have saw that CNBC wrote an article about how American billionaires got $434 billion richer because during this pandemic and lockdown, people were spending more time scrolling through their Facebook feed and buying more things on Amazon. So comment after comment, people were hating on Jeff Bezos and Mark Zuckerberg because their stock share prices went up. But it doesn't make sense. People were spending more time on Facebook and they were shopping more on Amazon, which made people and investors more interested in investing in these companies, which made the share prices go up, which made their owners and shareholders more wealthy on paper. But what the article didn't say, and I think should have said, is that anybody, including you, could share in this upside by just investing in these companies. Like if you went out and you bought one share of Facebook or Amazon or McDonald's, now you become one of the owners of these companies, and when these companies make money and their share prices go up, you win too. That's why I want you to 1, learn how to use your money the right way, and then 2, learn how to use the system to your advantage so you can use it instead of getting abused by it. I know I'm preaching to the choir here, but hating isn't gonna help you take better care of yourself and your family and your community. Educating yourself will. Now, when it comes to where we are in the economy right now, practically speaking, we are not in the clear yet. I mean, we have 40 million people without a job, we have a shrinking economy, we have a ballooning national debt, and we have this risk for inflation coming and smacking people in the face with it in the near future. Now look, I'm just a random guy on YouTube, so I don't know what I'm talking about, which is why you need to make sure you do your own due diligence, because investing has risks. You are never guaranteed to make money when you invest. At the same time, you have the Federal Reserve coming out and saying that they're gonna do everything they can to prop up the market and the economy and keep it strong artificially, which means, at the very least, we have a very choppy year ahead of us in the economy and the stock market. I want you to hear this and see opportunity, because the reality is there's going to be a lot of wealth building opportunities that come our way over the next 12 months. This is what financial education is all about, so you can use your money as a tool. And if you're looking for an easy way to up your financial education, well, we have a free ebook on money management and investing that you can read for free when you sign up for our financial education emails, which are also free. You can get a free ebook and start getting our financial education emails by clicking the link up here or by clicking the link in the description below. By the way, our financial education emails are different from our financial news emails. Thank you for watching. If you enjoyed this video, share it with one friend, that way we can help spread the word. If you want to learn more about how to find a strong company to invest in, I already made a video on it, and you can watch this video on YouTube by clicking this button right over here. Thank you for watching, and as always, keep hustling.